Most people imagine the stock market as a wild, glowing room full of shouting traders and complicated screens. It feels dramatic, distant, and a little frightening. But underneath all the noise, the stock market is built on a very simple idea: people buying and selling tiny pieces of real businesses. Once you understand that one idea clearly, everything else about the market starts to make a lot more sense. At its core, a stock market is a place where people trade ownership in companies. When a business grows, it sometimes invites the public to own a small share of it. Those shares are then bought and sold among investors. The market itself is just the organized system that allows these transactions to happen safely, with clear rules and visible prices for everyone to see. This matters because when you own a share, you are not just owning a number on a screen. You are owning a small piece of a real company with employees, products, and customers. If that company grows over time, your slice grows too. If the company struggles, your slice can also struggle. Shares are not magical tokens. They are tiny ownership certificates connected to real-world activity. To understand how it really works, picture two main groups. Buyers want to own shares, hoping the company will grow. Sellers want to release shares, perhaps to take profit or shift their money elsewhere. The stock market matches these two groups. The price of a share is simply the latest point where one buyer and one seller agreed to exchange. Every price you see is the result of a recent meeting of minds. Let us look at a simple example. Imagine a company that produces a popular product. As the product sells well and the business expands, more people want to own a share of it. With more demand than supply, the price tends to rise. If the product later becomes less popular, sellers may outnumber buyers, and the price tends to fall. Prices move because expectations move. A common mistake beginners make is treating stock prices as proof of company quality. A rising price does not always mean the business is strong, and a falling price does not always mean it is weak. Prices reflect expectations, news, emotions, and recent flows of money. The underlying company is a separate, slower-moving thing. Confusing short-term price action with long-term business strength is one of the most common investing errors. There is also a hidden risk in following the market too closely. Daily price changes can be loud and emotional. People who watch the screen constantly often react to short-term noise. They sell during fear, buy during excitement, and rarely follow a clear long-term plan. The market rewards patient owners more than nervous traders. The closer you stand to the chart, the harder it becomes to think clearly. A useful way to picture the stock market is as a giant marketplace full of small business slices. Some slices are popular today. Some are out of favor. Some grow quietly for years before anyone notices. Some fade slowly while still trading. The marketplace itself does not decide who wins. It only sets the prices people agree to right now. The real winners are decided over years, by the businesses themselves. A second key idea is the difference between investing and speculating. Investing usually means buying ownership in companies with the expectation that they will produce real value over many years. Speculating usually means trying to predict short-term price moves. Both happen in the same market. The first tends to reward patience and broad thinking. The second tends to reward short-term luck more than skill, and often disappoints in the long run. A practical example helps. Imagine someone who buys a broad fund of many companies and holds it for 20 years. They do not pick winners. They do not try to time the market. They simply ride the overall growth of the businesses they own a small piece of. Now imagine another person who jumps in and out trying to outsmart short-term moves. Over time, the patient investor usually ends up far ahead. Beginners often misunderstand the role of news in the market. Headlines can move prices in dramatic ways during short periods. But over many years, the underlying performance of companies drives results far more than any single news cycle. Markets are noisy in days and weeks, and surprisingly meaningful over decades. Investors who learn to filter daily noise from long-term value tend to make calmer, better decisions. There is also a psychology angle. The market tests every emotion you have about money. Greed during rising periods, fear during falling periods, regret when you miss something, pride when something works. Many people lose more to their own emotions than to the market itself. Understanding your own reactions is part of investing. Calm habits, automatic contributions, and clear long-term goals quietly protect you from yourself. A simple practical rule helps you participate calmly. Invest only money you do not need in the short term. Choose broad, diversified options if you are unsure where to begin. Contribute regularly, regardless of what the market is doing. Avoid chasing the most exciting stocks of the moment. Let time do most of the work. These small habits, used together, quietly turn a noisy market into a powerful long-term tool. There are things to avoid. Do not borrow money to buy stocks unless you fully understand the risk. Do not invest in something you cannot explain to a friend in 1 or 2 sentences. Do not measure your worth by daily price changes. Do not believe anyone who promises certainty. And do not pull out long-term money during the first big scare. The market is uncomfortable sometimes. That is part of how it works. A better habit is to treat the market as a tool, not as entertainment. You do not need to know what every chart did today. You do not need to watch every announcement. You need a clear plan, a reasonable allocation, and the discipline to keep showing up. Most long-term wealth in the markets goes to the boring, consistent owner, not to the constantly active spectator. Boring is often the most profitable style. Over the long term, the market behaves more like a slow climbing road than like a roller coaster, even though parts of the journey feel exactly like a roller coaster. Many companies grow, some fail. Diversified investors quietly benefit from the overall progress. The future is never guaranteed, but the long-term direction of broad markets, across decades, has historically rewarded patient owners far more often than panicked traders. So here is the short version. A stock market is a marketplace for ownership in companies. Prices reflect expectations, news, and emotions in the short term, and underlying business strength in the long term. Investing means owning real businesses. Speculating means betting on short-term moves. Diversification and patience reduce risk. Time and consistency matter more than timing. The market is a tool. Your behavior decides how well it serves you. If you want to use the market wisely, start by owning, not predicting. Buy broad, diversified pieces of real businesses. Contribute consistently. Ignore daily noise. Stay invested through ups and downs. Adjust your plan only with calm thought, never panic. The stock market is not a casino, although it can feel like one if you treat it as one. Treat it as a long-term partnership with the businesses you own, and it usually rewards that patience.